Okay, welcome to Ask the Experts. Oh my God, we're in our brand new owned podcast studio. Eric Schurenberg, editor-in-chief, a.k.a. Chief.
Hi, Jill.
Good to have you back here. You haven't been on the air in
been
a long
while,
time.
hasn't it?
No, we need to get the good stuff here for the launch of the new podcast studio. And Ray Martin.
Finally back. Hail to the chief.
There it is. And hail to my other chief here.
Good to be here in the podcast studio.
Well, I mean, first of all,
That's kind of cool.
This is so cool.
This is a pure podcast. This is what it looks like, folks. This is a podcast.
It's
studio.
gorgeous. And want to remind you that here it is, our very own live webcast. And we have our own live webcast page on the website, on the beautifully redesigned and gorgeous MoneyWatch.com site, which Eric and his team work so tirelessly at.
You should check it out. New front door.
I need to check out that front door. Absolutely.
Walk through that front door, my man. You
ready.
can't imagine what's on the other side. It's fabulous. It really is. It's so awesome. Getting great feedback from people. So just want to remind you, you can always comment on the show and ask us questions live. You can also send us an email, which is asktheexperts@moneywatch.com. And we, guys, I know, don't go crazy here. Yeah, it's going to be a great September, blah, blah, blah. Let's answer some questions. The markets have had a great month, good quarter.
Yeah.
People got questions. Good time to ask these questions. People seem to be in the mood. They're back to school with their finances. You like that, Ray, right?
I do. I mean, being in the mood to deal with it is a lot better than just being apathetic and sitting around going, oh my God, what are we going to do?
Exactly. Or like, I'm so scared to open my statement.
And people are tired of earning nothing on cash, too. They're just tired of it.
Yes,
right?
That's probably a good sign for the market.
Yeah.
But I don't know. For the long term, who knows?
Exactly.
The markets are difficult these days.
Aren't they?
Very tough to know what to do.
What is this? Like, you're going to bring them down? Let's get them psyched. Let's make this a sport again, Yeah. Come on, we're psyched.
I read a J.P. Morgan paper, Eye on the Market. They put it out every week, right? And they had a conference call with their chief investment officer last week. And according to them, a noted hedge fund manager said, buying stocks right now is probably a no-lose proposition. Okay? Now we're talking single digits here, but here's why he said that. He said, if the economy is growing and it's going to be stronger than thought, stocks go up. If the economy's worse, the October payroll report coming up and the GDP report end of the month, if it's worse, the Fed pours it on.
Reflation, baby.
And that's good for stocks.
It's on.
It's good for stocks or good for stocks?
All right.
I don't know.
All right. Well, we're going to get to some questions, and we want to thank everybody who sent us questions. If we don't get to your questions this week, check back next week, because there's always another show. So let's go. We're going to start with Monica, because she's just starting off her financial life. She recently got a mortgage at 3.9%.
Wow.
Hello.
Way to go, Monica.
Purchasing a new home. She says, it's so cute. I have nothing else going on for me. Retirement funds, investments. Often I hear that one should start saving for retirement in their 20s, but in my head, getting rid of my debt takes priority over everything else, including savings. What's the best way to go about this? Is it smart to look at stock investments at this point, or am I taking on too much too soon? She's 29 years old. Seems to me she's got a house. She's well ahead of the game. What do you think, Ray?
Well, Monica, I love a girl like you thinking about getting your debt paid down here. However, think about where you want to be down the road. Do you want to be house rich, have a paid off house, but no financial assets, which are liquid, can be transacted quickly if you have an emergency need or there's something else you want to do or buy? Not a good position to be in. Financial planning is about balance, doing a little bit of both of those things, pay down debt and building your assets at the same time here. And having 3.9% mortgage, I mean,
That is really good.
That's cheap money, right, Eric?
I would think the thing you want to think about is where you're going to get the highest return right now.
Correct.
So if you are talking about paying down 15% mortgage,
great.
Well, I would say that's an easy one.
Right.
That's an easy one. If it's the only debt she has and the only debt she mentions is this 3.9% mortgage, and it's 3.9% and tax deductible, why bother? Why bother? Get liquid.
So what we're going to say is hang on to that mortgage, Monica, and start with your saving and investing. Start with if you have a 401k plan, use it. Make sure you beef up your emergency reserve fund before you do that. But rock and roll, get going, girl. And you know what? You are on your way. I mean, that's the most amazing thing. She's 29 years old. I could get her hooked up to some, crazy guys I know who spend a lot of money. It would be a nice thing, sort of like socialism with making love connections. Okay, our next one, nice. Jay in Arizona. Virtually all of his assets are in his rollover IRA. My only other income is Social Security. i.e. Jay is of Social Security age. My assets are about $1 million. I took out an umbrella insurance rider for $1 million. Eric Schurenberg, does he need this umbrella policy? He asks, can my IRA assets be attacked by the court if I were to be sued as a result of an accident or negligence?
Jay is lucky he lives in Arizona because the answer to this question depends on what state you live in. IRAs are protected to different extents by different states, but Arizona is one of the best states. Your money is free of this kind of threat except for the money you've just put in with the last 120 days. Sounds like Jay's been around a while and that money has been accumulating for a while, so it's pretty safe. But to answer the question for people nationwide, you better look at your state law. The money inside an IRA is safer than money outside, but it's not as safe as the money in a 401k. And it can, in many circumstances, be subject to a lawsuit. So be careful.
Which is why, by the way, O.J. Simpson, when he lost his civil lawsuit, was able to shelter all of the money in his NFL 401k because it was protected against litigation, which is one of the reasons. If you happen to be in a, let's say, high-risk trade, I don't know, you're a drug dealer on the side, something bad happens to you. You got some other stuff, gun running, something like that. Doing internet porn on the side, get caught, you might want to not roll over your 401k. Keep it in your 401k. There's a little hint for all of you felons out there. Yeah. Keep the money in the 401k. So 401k ironclad, IRA subject to state rules. But by the way, I like umbrella policies. They're usually cheap. And if he's got a house and
the
sometimes
policy probably costs him
bupkis, right?
A couple $100
That's
a year or
yes.
less, maybe $150 a year. You know, you create a deep pocket with the insurance company. You kind of create an advocate on your side that if you get a civil suit against you, you got somebody defending you. And it could be a bogus claim. Somebody could claim they walked up your steps in your house and slip and fall, and they really didn't. And the insurance company's going to hire an investigator, investigate that person, find out if it's a bogus claim or not, and they're going to do it on their dime because they have $1 million to lose.
That's right.
So for $100 or $150,
That's what I think.
right?
I always like those umbrella policies because they're cheap.
So
Cheap way of protecting
Bill Clinton
yourself.
was glad he had his.
Yes, indeed.
Remember that story?
Now, instead of talking about all this stuff.
President Clinton, excuse me.
Yes,
Yes,
right.
your best friend.
Yes, right.
Okay, now
Yours
moving
and mine.
on. I love this. Kaz wants to know, he or she, not sure, turned 70 and a half in 2009. I'm aware that there was an extension from minimum required withdrawals until this year. Ray, will Kaz be penalized if she has not withdrawn anything?
Well, it's game on for 2010, meaning there's no exemption from the required minimum distribution rules. You'll have to take your RMD, required minimum distribution, this year before December 31st. And the penalty is what, 50% of the shortfall? It's huge.
Right.
It's a stinger.
Yeah.
So
Yeah.
you're
You
going
don't want to miss this one.
Yeah, you don't want exactly.
On the other hand, to answer Kaz's question about whether she is in trouble for not having taken a withdrawal by April 1st, she's off the hook. That was the benefit of the congressional grace period.
For the 09 distribution.
Because of turning 70 and a half in 09.
Correct.
Very interesting. I'm just trying to find something here because, of course, Megan is pestering me while I'm very, rapt with my attention on our question and answer. Okay, here we go. All right, I had to do this now. Wait a second. I got this. Now I've screwed it all up. Okay, so we have a live chat going on. So now we have all sorts of people dialing in and saying, for example, Jack Otter, who's just, really just utzing me from across that wall.
Otter, yes.
Yeah.
I know that name is familiar.
Yeah. Anyway, so he says he's not planning on dealing. He means movie making. He's going to think twice before rolling over his old 401k. And Doug says, "Oh yeah, there's that old risk reward." And Susie, the tireless Susie, says she's always looking for tips about her side job as a felon. She was very happy about that. And Mike, yes, you're welcome for that good advice about. It's not hiding money. It's sheltering yourself, protecting yourself from litigation, boys and girls. That's all. I worked in Rhode Island for 15 years. This was an issue I had to deal with. You smile. You may know some people.
Well, Rhode Island's got a checkered past. Yeah, with some folks there, yeah.
Exactly.
Yeah.
And we also got some people
Good state, though. Drive through it in 5 minutes.
And there you go. And by the way, we also have a whole bunch of people who are commenting on Monica's 3.9% mortgage rate. They're kind of a little jealous about that.
They
all
should
right.
be. Envious.
That too. All right. Ray, this is
Mortgage envy.
Mortgage
That's
envy.
right.
I like that. We're going to have a special icon for that. Kathy has a question about long-term care insurance. Now, remember, that's basically when, as you get older, when the money that you think Medicare is going to pay, they're really not going to pay as much as you think for nursing home care in your own home. So my husband and I are in our late 50s. We have an estimate for long-term health insurance for $4,000 a year. Guaranteed not to raise in premiums, not to be canceled for poor health. $2.5 million in net worth. Should we buy this policy, Ray, or is it better to put the $4,000 away every year in investments and have the money available, assuming we might need long-term care in our 70s?
Well, long-term care insurance provides a benefit for potentially something that could happen to you, but it's not certain that it will. Meaning you could go, as you leave this earth, you could transition through a nursing home on the way there. And what could that nursing home cost be? $60,000 a year to $120,000 a year.
$200 in a nice place.
And it depends on the place you go. I'm on a board of a place up in Saratoga Springs, New York. I think they're a really nice place, and they're about 60, 65. That's upstate. And in New York City, the benchmark cost is like in the 110 range.
Right.
And, it can be even more. You're right, you're absolutely correct. So times 3 years, 100,000 times 3 years, $300,000 in potential costs here. Women, you go to a nursing home.
Can I just make
nine
one-
out of 10 are women.
Yeah, and
not
let me just
men.
make one. You did something very smart. You said 3 years because the average nursing home stay and the average need for long-term care is something like 3.9 years, right?
3 to 5, right.
And often I know that insurance agents, don't write us. We know you're mad when we say things like this. Always sell you lifetime benefits. But it's a ripoff because no one needs it for 40. Yeah, my grandmother was in for 25 years. It's so the outlier, 3 to 5 years, right?
Yeah, that's the range. So it boils down to she's asking should you buy it, and you're buying insurance to protect from a risk that may or may not happen. You have enough net worth here to probably pay your own way. So what's going to mean is if you don't have the long-term care insurance, and if you go through a nursing home, and women are more likely to go out that way than men. Men have the good fortune, among a lot of other things, just die quickly, and women have to pick up the pieces and deal with and then they go to the nursing home. So the women buy it, maybe. The men buys a smaller policy, if at all, in a couple situation here. But, you got enough net worth here to pay your own freight. It means your kids will get a smaller inheritance. So really what you're doing here is buying the insurance to make sure your kids get more of your wealth.
Right.
That's the way to frame it.
Portfolio insurance, basically.
Yeah,
or
exactly.
Inheritance insurance.
If you had $1 million net worth and you wanted to make sure that goes to the kids, it's an easier. If you had $200,000, you'd spend down and be on Medicaid quickly.
Right.
Yeah.
So there's a bracket.
Yeah,
I
would. You think
right?
that? Yeah, I would always say that if that scary area is like if you have a net worth of say $300,000 or $400,000, and up to like $1 million, because a lot of that often is in your house, and people don't want to be forced to move, and
That's
so
right.
then but you're absolutely right, Ray. I think the idea that you don't have to insure for every penny either.
Right.
You can say partial. I can get
Right.
make up for that. So I guess that what we're saying to Kathy is that maybe if you want to protect your portfolio for the kids, you got $2.5 million. You can certainly self-insure. You can pick up a little bit of coverage. It doesn't have to be every last dollar.
Or a 180-day wait before
Exactly.
benefits kick in.
Exactly.
Instead of a 90-day
Right.
wait, it's like a deductible. Make it longer, and then it costs less.
Yep. So, but I do like long-term care for that very specific person.
Where to buy? Where to look?
Yeah.
Right.
Where to
I
look
think
for a good
it's
policy?
a really tough call. It's not one of those kinds of insurance like disability insurance that everybody needs who has an income, or life insurance, anyone who has a family. This is a tough call, and there are problems with long-term care insurance that make it kind of iffy at how it will pay off, unless you're really squarely in that, upper sort of wealthy but not really wealthy,
Right.
but not so poor that you'll end up on Medicaid sector. You can give it a pass.
Yeah. Now, which companies do you like?
Well, I think you look at...
And we are not endorsed by any of these.
If you're a member of, you're going to be buying in your 50s, probably is when people start getting serious, 50s or older. So if you're a member of AARP,
Check it out.
Look at their affinity group. And who's the company that they're linked up with? Is it,
Are they Met?
It might be Met.
It might be. I think
But look at the AARP website, and they'll have probably one of the best deals.
I always thought
there.
that the thing about long-term care insurance is that everybody mispriced it, and then they kind of screwed you after they mispriced it, right? Because they're like, hey,
Right.
you know what? Oh, your premiums are
Yeah.
going up by 30%.
Yeah.
Sorry.
Yeah.
And the ones that didn't misprice it were the big fat insurance companies like MetLife,
Right.
like Prudential, and I think There was one other one. I'm going to, maybe New York Life was the other one.
If they're in that business.
I'm not even sure they are anymore.
Yeah.
But I know that MetLife and Prudential were the ones who really kind of like said, we stand by the policy. We're not messing around. And that's a good thing to know.
So interesting. Women are more likely to go in a nursing home than men, as I mentioned earlier. You go to a nursing home, 9 out of 10 residents there are female. And, there's an irony to that, too. The men that are there are like, finally, I'm in a house full of women, and I'm too old to do anything about it.
No, I don't think I
Is there an insurance policy you can buy against that?
I don't know about that. Hey,
The Viagra policy, right?
Exactly. There you go. Start squirreling your little blue pills away. Next question's from Brandon. Opposite end of the spectrum. I took out a large amount of student loans to finance my graduate degrees. They totaled nearly $100,000 when he graduated in 2006. Wow. He's working at a fantastic job. Amazing. That's good that he has that. I'm making a pretty good salary. I'm still struggling to make my student loan payments. I've heard that if you stop making payments, the punishment can include the garnishing of up to 15% of your wages. Honestly, that sounds like a blessing. I'm currently paying 45% of my take-home pay to student loans. Aside from tarnishing my credit, Ray, what other punishments can he face if he stops paying the loans fully each month? About 2/3 of the debt is from private loans. Any advice?
I would look at restructuring the payment options or choosing a payment option to something that's more affordable. 45% of his income is kind of the bell ringer for me.
Yeah.
And there are a variety of student loan repayment options. There's an income contingent repayment option, which starts off low and rises as your income rises over time. There's this new repayment option that just got restructured again. It was new in July of 2009, and it just got restructured a couple months ago, called income-based repayment option, or IBR, where the payment is capped to 15% of your income over the poverty level. That's worth looking at. What's the website for
thank you, Ray, for pointing this out. This is ibrinfo.org. And, it's kind of cool. There's a calculator here, and there's registration, and there's some stuff here that you can get some information. I think that what is kind of the most important thing here is when you have so much of your income that is going out to specifically one loan, and it's not a house where, you can get maybe some help with dealing with a company, you got to go and talk to the people. Right. You got to go and say, look, I can't make this. I can't do this. I am going to pay. I have a job. I'm a great credit risk because I'm going to keep paying, but you got to help me out here. And I think that's where you have to do it.
That's exactly right. You start with that process and ask, are there more affordable payment options that might stretch it out longer, but make the payment smaller as you do it. So it right sizes to your income now, and then you can always pay more later as your income goes up.
I'm thinking that Brandon and Monica should hook up. Monica has the house. Brandon's got a little debt.
Got the job.
He's got a job. He's got a little cash. Look, it would work for us. Okay, Kevin asks.
There's a great idea there. They have all these match
we
website.
Can do it.
We could do financial match.
That's right.
I mean, money's a big problem in relationships, right? We should start off
a and you say,
dating website based on finances and
credit
scores.
Everyone who's watching the show has to sign a non-disclosure agreement right now.
That's right. I like that idea. And I'm such a yenta that I love that idea. Right in. Okay.
What do you think? Girl looking for a guy with a big net worth.
Nice. Very good. Very good. Stephen, are you watching that? Get the sales team on that right now. Okay, Kevin asks, I have a 10-year investment horizon before I have to start drawing on my 401k IRA portfolios to provide retirement income over other sources. Blah, blah, blah. Given that interest rates can't go much lower, assuming they won't turn negative, exclamation point, that's a funny comment, which makes an investment in long-term bonds questionable at best, what would a reasonably well-diversified portfolio look like for me? He's got Vanguard funds, and he wants to keep investing in Vanguard funds, so bully for you, because we love Vanguard. But, Ray, if you've got 10 years before you need your money, and it sounds like he's got Social Security. He's going to have a defined benefit pension, so he's going to have some money coming in, and that's nice. What do we think about a portfolio for this guy? Let me I said Ray, but I really meant Eric. Eric, what do you think? Where are we going with this?
Well, I think that we ought to have a substantial amount in stocks. It sounds like Kevin doesn't really have a lot of faith in the bond market right now, and there's a good reason for that, but I would never totally get out of bonds. They are the best protection you have against deflation, and there is a real threat of that right now. But the fixed income portion of the rest of his life is, or at least his retirement life, is taken care of in part by this defined benefit pension he has, which makes him one of the rare lucky people who still has one of those. So to put a number on it, I would say 60% stocks, 40% bonds and cash. That's always a safe bet. When I worked at Goldman Sachs, there were people, brilliant Russian mathematicians who would figure out people's exact portfolio allocations. And it always came out to about 60-40 after they plugged everything into the calculator anyway. So 60-40, that's what I would say, Kevin. But don't let that your worry about long-term bonds right now get you totally out of the bond market. Deflation could happen, and that's your best protection.
All right.
So let's take your 60-40 allocation. Your 40 could be 10% cash, 30% bonds. Your 60 in stocks could be 25% large company U.S. stocks. A lot that pay high dividend yield. 3%ers or better.
Sweet.
10% could be mid-cap stocks. Big companies with big cash balance sheets are buying mid-sized companies, so there's a good floor support there. The other 25% of that allocation to stocks could be foreign, and at least half of that 25% be emerging markets.
Definitely.
Right?
Definitely.
At
Definitely.
least.
Want that emerging market exposure. And Vanguard's got plenty of choices, and Vanguard's got ETFs they can use. So there's a great portfolio for you. And keep it simple. You don't need 400 zillion different assets. You need some good, solid funds that are going to give you exposure and grow. And then, Kevin, the hard work begins when you actually have to take the money out. It's always easy. I always find accumulation phase pretty easy.
It's got 10 years.
Yeah.
Right? 10 years to wait it out. Right?
Yep.
And
The
of course,
next
he
10
has 10 years. That's when he starts retiring and living off this money. So, he's actually got a long investment horizon. It's maybe 40 years.
Yeah, and he's got IRA and a pension. So he's not using it only, it's not his sole means of support. So he probably can kind of move it along.
Yes.
And Social Security, right.
All right. Here comes a lot of people that people are going on the chat room. So I have to do this because how can she answer questions if she reads them on paper? Because Lionel, because I'm doing both. I'm multitasking, which means I'm not doing anything well. So I'm doing my best. Slow down, Turbo. Okay, here we go. One woman, actually, Cindy wants to know, is long-term life insurance a good investment for the 20-something-year-old? The answer is long-term life insurance, a good investment. I don't know if you mean long-term care, because long-term care we would definitely not say if you're 20 years old. No. But if you're talking about any sort of cash accumulation life insurance policy, again, please, insurance companies, don't watch this. I don't get it. I'm sorry. I mean, whole life for a 20-year-old? That's a rough go, right?
I'm licensed to sell insurance, and I still don't get the cash value.
Wait, if tax rates go up double, triple from this level, then maybe it starts to make sense because it is tax deferred. All right, I'm trying, man. I'm trying to preserve our future sponsorships, and you're screwing me right now.
Well, yeah, there are. Look, when it comes to estate planning, then there's a permanent need there in a trust. You're going to use a cash value life insurance policy for paying estate taxes.
Yes.
Okay.
But not when you're 29.
Yeah. In certain types of business agreements, you might use cash value policies for different unique ways, but not a 29-year-old just looking to. First of all, do you have anybody that is dependent on your income right now that needs the insurance proceeds if you die? And if you're single with no kids,
right.
Probably not.
Yeah.
Right.
Yeah.
So you may not need any insurance, life insurance at all
at this point. Right.
Yeah.
Here we go. MoneyWatch panel. Do you think mortgage rates are likely to keep dropping, or do you think that we're at or near the bottom? Well, I'll go first. I just refinanced, so I'm done. I just really feel like if it goes down a little bit more, I'll watch it go down. But if it goes down more, there's probably some big problems going on in the economy, and I've got other things to worry about. But I just locked in. I'm done.
Well, I'll just tell you how I'm voting with my own feet here. I mean, I don't have a mortgage, and I'm thinking about taking some of this cheap money out just because it's so cheap, and you can borrow it close to 4% at this point. But I'm just not there yet either to do it. But it's really unknowable. But the Fed there's a housing problem out there, a big housing problem. A huge number of homes are worth less than the people owe on them, and they need to be able to refinance those, and they need to be able to fix that housing market issue for our economy to heal. And that means mortgage rates got to stay low and maybe even have to go a little bit lower from here.
Yeah,
and that's the Fed stepping in to buy mortgage-backed securities.
All right, Eric,
Yes.
come on, counterpoint.
Well, all right, so here's the counterpoint. There's not much room between 4% and 0. So
4%, actually.
400.
Yes, right, exactly. There's 400 basis points. All right. Everyone passed the math test?
Okay, Captain Obvious.
Right, exactly.
So how much lower can they go, and how much would it save you? If you're thinking about, well, do I move now or do I move later? I mean, what's the upside? It's not that much. The other thing, to your point, Ray, the way for the Fed to get housing prices going again is to inflate. And inflation goes up, so do mortgage rates. So the pressure in that sense, I mean, here I was just telling Kevin not to totally get out of bonds because deflation might be a threat, but also a lot of people believe that inflation is what's next, and that what the Fed ought to do is be promising a high rate of, a target rate of inflation. That would cure the problem of people who are in debt. It would get all those people who are underwater on their housing value. Perhaps get those home equities back up. Anyway, I think what I would say is move. What are you waiting for? 4%? How much better can it get?
Yeah, it's...
and it could get worse.
Having said that, each round, each year, it's been, I'm ringing the bell, this is the low here. And wham, you get hit with just another historic drop in mortgage rates. I mean, it's really tough to...
Big shot. You got a fan in the chat room who says... Wait a minute. I officially love the dude who just said Captain Obvious. All right? You guys, that's so my catchphrase. You got some love in the chat room, okay, baby?
Finally!
There you go. All right. I got to shift gears for a second here. This is so great. I apologize for the whole discussion thing. I really am. This is our first time. Back off. Okay. We had a question about going back to the long-term care insurance. Someone wanted to know exactly what does that cover. So long-term care policies, you have to check each policy is really different. So you have to check what it is they cover, and it's not just catastrophic. It can be, I need help with the daily living activities that I can't do myself. I need help with having someone come into my house. But again, every long-term care policy has its own specific coverage.
They can cover home care.
Home care, or it can
which
be...
you want to make sure home all the way
Absolutely.
to skilled where you're bound in a bed and somebody's feeding you every day.
Right.
And everything in between.
So you really have to check.
Yeah. Most policies today cover, if you need help for somebody for 3 of the 5 activities of daily living or ADLs to an assisted living facility, to some care there, to custodial, some custodial care, but skilled care is really the big cost item. That's the big number. And
Otter just weighs in. He says, by the way, AARP teamed up with Genworth, which was the previously GE Capital, which had a fabulous long-term care policy. So Genworth and AARP, so you check that out if you qualify. I'm not there yet, boys. It's just around the corner, though.
If Jack can do it real quick, tell us what the year-to-date return is on Genworth stock.
Year-to-date return, Jack, Genworth stock.
If you can tell us that.
Yeah, don't be... By the way, if he's got so much time to do that, why isn't he in the studio making Eric do the work? For God's sakes. Yeah. Okay. Here's another... By the way, this is a piece of paper. We use paper sometimes. Okay. I'm snarky this afternoon. I have a simple IRA account with Fidelity that was being funded by myself and my employer. Simple IRA was really for small businesses. And what was the limit? $9,000 or $12,000? I remember it started, it was $9,000.
11, 12, 13, yeah.
Anyway, there's only $5,000 or $6,000 in the account. I'm not with the company any longer. I need to roll it over. I'm currently a small business owner, a sole proprietor with no employees. It's not, and by the way, there's so many of the small business people are sole proprietors. Right. They don't have a lot of employees. So this is a good question. It's not likely. There's a small possibility in the future that I may want to bring on employees and or employ family members such as my husband and children. I was a small business owner and I would really guard against that. But okay. Most likely, anyone outside of my family that I bring onto work will be an independent contractor. Is a solo 401k the way to go for Wenda?
I like the self-employed profit-sharing Keogh 401k plan. That's the formal name of it. I like it because it gives you the ultimate in flexibility. You can contribute as little to it, 0, or up to You got the
44?
401k contribution
45?
plus
What
the
is
profit sharing contribution, so it works out to something in the 40s now.
Yeah, 45
And if you're over 50, you have the catch-up contribution that you can make in, like 49 grand.
Yep.
So it's the ultimate in flexibility there. You have the employee contribution you can make for yourself, and then the employer contribution you have to make for yourself and any other employees that you have there. It just works for me.
Yeah.
I don't look at all the other versions of
the solo
self-employed
401k.
retirement
Yeah,
accounts.
I think the SEP IRA works fine. SEP IRA / KEO. It's an easy one. It's flexible, and don't hire employees if you can avoid it. Finally,
there's a tax move to hiring kids.
Yeah, I know.
Where you can.
But
and
you know,
there's
all
FICA
that
tax savings and all that jazz
But
too.
you know, it's
so
also the-
talk to your accountant about that.
there also has to be the life, sanity check in case you want your family involved. Because Ray, I bet you had a few clients and their family businesses doesn't always go as expected.
Yeah. Yeah, but there's.
Who would have ever heard of such a thing?
But there is a good tax move to
Yes.
paying your kids a little salary.
Yes,
That's right. Yeah.
What are you paying Emily?
A ton.
Yeah.
No, I don't want her working. I'm paying too much for her college tuition.
Oh, there you go. Okay, we got the last question. And by the way, thank you so much for everyone who participated in their live discussion on our site. Judy asks, she has several $1,000s in a 401k. She hasn't worked for several months, so income is small this year. She does expect to go back to work at a good wage soon. God willing, she should get a job. Would it be a good thing for me to convert my 401k investment to Roth IRA while my income is low? Eric, she's 58. She plans to work another 7 to 8 years. You like the conversion?
Yes, I think it's smart. Do it now. Well,
Yeah.
The problem with the conversion is you have to pay taxes when you pull the money out of the 401k or the IRA. Well, she'll have to roll the money over into an IRA, but it's very smart. Good for her.
Yeah, I think that's a good one. Maybe she'd like to date this man, Kevin, who has a school debt of $100,000, a little, cougar thing going. Manoj says, from the investment portfolio standpoint, are bio-drug companies going to be the future, and is pharma research behind us? Got an opinion about that? I actually have an opinion about that.
Let's
Well,
hear
you're
yours.
from that.
Yeah.
You're from the whole 128 belt there, and you do business in Boston.
Yeah, I'm on the board of a company that helps big pharma do their ratings of drugs that are in phase 2 or phase 3. And big pharma is sucking wind in a lot of ways. Their R&D costs are up, and the number of effective drugs are way down. Their cost per effective drug is just skyrocketing. So it's really tough. And the way around that, the smaller, more nimble biotech companies are able to work with private equity and get down a big, if they get a big win, there's a big private equity win there, and their funding and their costs are much lower. So, it's tough to watch it.
But I will say that some of those big pharma stocks, they have sweet dividends, and they ain't going out of business
There's
anytime
a reason
soon.
for that.
Yeah.
The stock price is so low.
Yeah,
There's a reason for that.
So I'm going to be. I'll tell you what. I would be.
tough.
I'm not an individual stock picker, but if I were sitting out there and I'm looking at like a company like Bristol Myers or Pfizer, I
Pfizer.
could get paid to wait 3 or 4% till things kind of change a little bit and see how healthcare reform comes about. I'm okay with that. I think that you can't be a pig, like we said before. Expected returns in portfolios, if you just kind of set your sights lower and you look at good dividend streams and you look at good businesses, some of these companies are going to do better than others. I get that. But remember that a lot of those biotech companies are going to go broke also.
Oh, from an investment standpoint, you're absolutely right. I just saying from my position on the board of this company, I look at the struggles of big pharma and how they're just getting hammered with skyrocketing R&D costs and very little yield from that. And then you look at the generic pressure on their pipeline, with their patents coming out, and then the pressure on healthcare reform to push drug prices down. There's just nothing. The headwinds are just there for them, and I think there's a reason why their stocks yield so much, because their stocks are down.
Okay.
I think they're going to stay that way.
Now, let's finish this podcast with your one best money tip of the day. Eric, see, I sprung something on you.
Yes,
You're
right.
why now? Just he's like, oh my God, I've been up for 22 hours straight doing with this new website. But Eric, your one money tip for the day.
Save. You cannot save enough money. It's the one thing that won't let you down. It's the investment that won't go sour, the money you put away.
All right, Ray, your tip of the day.
It's not what you make, it's what you keep.
Nice. To be tax efficient, right?
Absolutely.
All right, that's good.
And that's going to become more important.
And Jill, yours?
My tip of the day, in going back to our idea of setting up a website that could be a sort of a love connection, a money love connection, is that, as my mother always likes to say, rich or poor, it's nice to have money. So it's just as easy to be with someone who has some money than no money. And when we launch our new website, we'll be putting those two kinds of people together. So, go out and work for yourself, work hard, and just remember, we'll be there for you. We're gonna find you love in all the right bank accounts. I mean, places. How's that? Thanks for watching Ask the Experts. I'm Jill Schlesinger.
Eric Schurenberg.
I'm Captain Obvious. I'm Ray Martin.
Captain Obvious over there. And next week, when we come back to Ask the Experts, I will be much better and more adept at managing the chat room, and we will answer more of your questions. You can shoot us an email, asktheexperts@moneywatch.com. Go to moneywatch.com. See the great Ray Martin and the great Eric Schurenberg and the minor Jill Schlesinger coming in, giving you practical advice that you can use every single day in your life. Thanks for watching.
The best thing